Good morning, ladies and gentlemen. Welcome to the Compliance Online Live Webinar, EBIT, EBITDA, Understanding Your Profit and Loss Statement. Our speaker for today is Candice Lillick, is the president of Athena Finance Group, where she specializes in strategic planning, distressed entity recovery, valuations, and education programs. Before that, Ms. Lillick worked as a manager at Ernst & Young and taught courses at Simon University School of Accountancy and Legal Studies, Furman University, and the University of North Carolina at Greensboro. Ms. Lillick earned her Master's of Professional Accountancy from Clements University. Candice, please go ahead.
All right. Today we're going to talk about the income statement or profit and loss statement. You can call it whichever you choose when we're speaking casually. For financial statement purposes, it is titled income statement when we have to publish these financial statements for purposes of the Securities and Exchange Commission or some other agency that requires the financial statements to be reported. And in that financial statement package, of course, there is more than just the income statement. But our program today focuses on profit and loss and what the profit and loss statement and what it can tell us. Because the only reason we as accountants exist is to provide information to users so that they can make the best decisions possible. Okay. So is operating the same as earnings before interest and taxes? Not if you record your interest expense as part of all your other expenses. And many times companies, if you've made a purchase of equipment and you've borrowed money specifically to purchase that equipment, that interest expense could be in the cost of goods sold category. And so we would need to pull that out to get to earnings before interest and taxes. So you just have to be cognizant that we're looking at our operating income, but we want to look at it without the income tax that we're going to have to pay, and look at it without the interest. And why do we do that? The reason we do that is because we don't have a lot of control over the taxes we paid. We can also determine growth by looking at expenses. If your marketing costs are going up, chances are that's because you are marketing more items, newer items, or you're marketing in more locations, and that's an indicator that there's growth. Not always. You have to tailor all of these things to the specifics of your company. Okay. And then how does my chart of accounts affect the P&L? How detailed your chart of accounts is, let's go back here where we can see the numbers represent each item in the chart of accounts. And so that chart of accounts helps me manage how much information is provided. You can see it would be very easy to slot those numbers in, and then you can compare your budget to your current period as well. Now, comparing budgets to prior period, not so much. You want the prior remember, the past is the past and we can't go back and change it, but we look at the current period compared to the prior period so that we can identify those red flags, the things we want to look at more closely. Other than that, you can throw away those prior period numbers. You don't need them for another thing, except, whatever you're required to have in terms of reporting and preparing your tax returns, that kind of thing. The budget is compared to the current period as well, not to the prior period. So, you can graph your P&L if you choose to. Think about it.